It's been sideways. This is the 7th day. Here's the daily chart. Those 6 days, and then today we had a double bottom on Friday. I talked about how strong this rally was, and I said it was strong enough to get a second leg up. The bears are hoping this is the second leg, a failure at the moving average and another lower high in a bear trend. And it is a second leg, but I still think we're going higher. I think this is going to remain the low for the next many months, possibly all year. We currently have a wedge, 1, 2, 3. And if we do get one more new low, the wedge will be 1, 2, and then 3. I don't think the market's going much lower. It may dip below 4,000 and test this gap on the monthly chart, March high last year. And I've been saying that I thought the monthly chart would get 2 bear bars. And I said they could be consecutive like this. We have actually 3, but 2 consecutive bear bars, or they could be separated by a bull bar. And then the question is, after the 2 bear bars, do we go sideways for 10 or 20 bars like we did here, or is it just a pause and we go up to a new high? I don't know, but I do think this is not the final high of the bull market. The monthly chart is very strong. We probably have to test this high. We'll probably go above it maybe later this year. I do think we're going to go sideways for 10 years, but I don't think this is the final top. I think we'll get at least one more new high before we enter a trading range. The trading range might not begin for a couple of years. Weekly chart, we have a good-looking high 2 buy, 1 and then 2. It triggered last week when last week went above the high of the buy signal bar 2 weeks ago. And last week, I mentioned it was a bull body, and that's important. I said this week might trade below last week's low, but there probably will be buyers below. For the bears, it's a bear trend, low 1, another low 1, but it's a bull bar after 2 good bottom attempts and a failed breakout below a double bottom. The odds are there'll be buyers below this week's low if we go below this week's low. So that's bullish as well. And then the daily chart, you can call it a high 2, 2 legs down, 1 pull by 2. You can also call it a wedge, 1, 2, 3. The important thing is we have 4 big bull bars closing near their highs here, and then 3 big bull bars closing near their highs. Look at all the other bars, right? These are exceptionally bullish bars during strong sell-offs. And with it coming back to back like this, I think the bulls are very aggressive. They're saying that this general price area is cheap, and therefore the market probably has to go higher. And I said the problem with this 2-day rally was everybody wanted to buy, but the stop is here, and that's more risk than what most traders wanted. So they wanted to buy, but not at this price, and that's why I said we'd pull back. This may be the end of it, double bottom. I said we may come down to this January 24th low or the 4,200 area and then form a higher low major trend reversal. But I think, as I said, this is going to be a pullback in this early bull trend rather than this whole rally being a pullback in this bear trend. So I'd like it to go below last week's low, which is, I guess, that low right there. I'd like it to get 50% down, maybe near this low. I want it to get overdone on the downside, but I don't know if that'll happen. I also mentioned on Friday that we had a higher low major trend reversal here and a little head and shoulders bottom, and we triggered the buy at the end of the day, but the bears are trying to get it to fail. So the bears are another lower high. You can call it a lower high double top here. Some computers will say this is the double top. The bears want to break below this and go below last week's low. As I said, I'm hoping we go below last week's low and then reverse up, because I'm not sure that Friday was an adequate test of the resolve of the bulls. I'm not sure it went low enough. Plus, it was only a bull doji after a pretty big bear bar, so it's not a very strong foundation upon which bulls want to build a huge bull trend. So I'd like the market to come down here, somewhere in this area. So I'd like it to go a little bit lower. And I'm looking to buy, obviously, for trades. The market's been in a trading range now for 8 months. So, I want to buy, hold for a day or 2 or 3. I want to sell, hold for a day or 2 or 3. And then obviously I'm day trading as well. But on my overnight accounts. I'm just looking for trades. Open of the week. We now know where it is, so I'll anchor this line to the open of this first 5-minute bar. Bulls are hoping that the higher low major trend reversal is the start of a bull trend. They want another higher low here. We have a low, a higher low, higher low. The bulls want a higher low and the market to continue up. Globex range. We have a spike pullback channel and a wedge, 1, 2, 3. A higher high double top with a Globex high, and then a double top with that. The bears are hoping we get a couple legs down to below last week's low. And bulls obviously are hoping that this is a pullback and a bull trend. Maybe a double bottom here around the moving average. What do you do right now? Well, you got 4 consecutive bear bars and a double top 60, double top 44. I'd like to see consecutive bear bars today, and I'd like this bar 2 to close on its low before thinking about sell the close. There's a little bit of a wedge here. You can call it maybe an expanding triangle, 1, 2, 3, or 1, 2, 3, 4, 5. Trading range, sideways for now 7 days. Market's deciding what to do. Every now and then I talk about the euro. Let me see if I have it over here. Daily chart of the euro. We have a double top neckline, and we're in the neighborhood of a measured move down. Okay, doesn't have to get there, but there are 2 other things going on here. We have 1, 2, 3. So we have a parabolic wedge if we get a reversal. We have consecutive closes below the trading range. That means a confirmed breakout. We'll probably try to get at least a small second leg sideways to down. But I'm not sure. I've mentioned this a few times, but not in the past few months. This is the monthly chart. We may be forming a big triangle. We've been sideways now for 7 or 8 years. A very strong reversal, very strong reversal. Weak sell-off, weak sell-off. It makes me think we may be forming a triangle where we got a low, a high, another low, a lower high, and possibly a higher low. So as you know, I'm expecting a bounce in the euro. Well, we're not getting it yet, but I'm expecting a bounce. And if we get a bounce from at or above this low from last year, then traders will start to wonder if this whole thing is a big triangle. And a bounce, it could last for the remainder of the year. Right now, on the monthly chart, there's no sign of a bounce. A little wedge, 1, 2, 3, parabolic wedge, and double bottom. But on the daily chart, we might be getting a reversal. So if we get several days up, then traders will be thinking about a possible final flag. Weekly chart, 3 legs down, 1 pullback, 2 pullback, 3, an expanding triangle, any kind of triangle, any kind of trading range late in the bear trend is often the final flag, and a possible higher low compared to last year's low. So I keep bringing up the point that we've been sideways for a lot of years, and reversals are more likely than breakouts, and therefore, even if we get down to this area, it's still more likely that we will reverse than it is that we'll break strongly below. All right, we're probably always in short. We have consecutive bear bars with at least one being big closing on its low. We have 4 consecutive bear bars, but 2 decent bear bars, 81 and 1. So theoretically, it's sell the close right here, but you're selling right at the bottom of the trading range, so that's not ideal. So what do you do here? You can be short. I'm not. You could wait for 2 if it closes near its low, then sell the close. I don't know if I'll do it. If I do it, I'll probably do it with a very small position, and if it keeps going down, add on. But what did we do with this price on Friday? They bought it, bought, and we're at it this time. And you want to sell, then they're not going to buy. Selling at the bottom of a trading range is usually a bad idea. It's better to sell above the bottom of the trading range, or sell after a strong breakout of the trading range, or a breakout with follow through. Can you buy above 2? Let's say 2 is a big bull bar closing near its high. Let's say it looks like 26. Then yeah, okay, but it's not. Right now it's consecutive bear bars, 5 consecutive bear bars. It has a big tail below. We're in a zone where bulls bought repeatedly on Friday, so you'd expect buying, but it's always in short. It's sell to close. But as I said, I don't want to be selling at the bottom of a trading range. I'll sell after it breaks out to the downside, but right now I am flat. If 2 closed near its low, I probably would have sold a small position, and then if it kept going down, sell more and build the position up. But again, as I said, seven days sideways here. Okay, sideways for a lot of bars, right? And we're near the bottom of it, so not the best location to be shorting. Better to be looking for a reversal up. Weekly chart, as I said, it was a weak entry bar last week, so we may have to trade below last week's low before the buyers come in. And daily chart is a double bottom higher low with the low from last week, but it's only a doji bar after a pretty big bear bar, so we may have to go down a little bit more before the buyers come in, both daily chart and weekly chart. You can see a number of traders sold the close of 2 because we had consecutive bear bars, one being big and closing near its low, bar 1, and then bar 2 at a bear body. So you'll get some traders who automatically just sell the close. And if 3 goes down, they hold. If 3 goes down far and fast, a big bear bar, they hold short. And if it does not, they'll buy back their shorts and bet on a trading range. Breaking below the 66 low, that's the higher low major trend reversal. And it looks like we're going to try to get below last week's low, possibly down to 4,200 early this week. But as I said, I think there will be a lot of buyers down there because I think a lot of traders believe that the low is in. They may not be saying it, but this is an extremely strong reversal, and this is another one. And that tells us that if we go below this low, the bulls will probably buy even more aggressively. And if everybody believes bulls will buy very aggressively below this low, a lot of traders will buy before it gets below that low, just in case it does not get below that low. And that often leads to a higher low major trend reversal. So the market's either going to get a wedge bottom, 1, 2, 3, or more likely we'll get too many traders eager to buy. They'll buy before we get below that low, and we'll get a higher low and a higher low major trend reversal. Bear case, there's still a 30% chance that we can get all the way down to the pre-pandemic low. Here's the monthly chart. 30% chance we'll get here. I think 40% chance we'll fill this gap above the March high last year. And right now, I think better than 50% chance we've seen the low, or at least the low of the next several months. Here we have a big bear bar 3, and what happened? Did traders sell it? No, they bought it. Okay, and therefore it's not as bearish as it appears. That's trading range behavior, and that's consistent with the market being in a trading range now for 7 days. Last week's low is here. As I said, I think we may have to go below last week's low. We may have to go a lot below it, down to 4,200, down to the January 24th low. Now, look at the high of 4. Look to the left. It tested the low of 2. So we have a gap, and that could lead to a measured move, either from today's high, measured move down, or from that high, measured move down below last week's low. Right now, it's sell the market, sell the close, right? We do not have a bottom. We now have 6 consecutive bear bars. That will reduce the number of bulls willing to buy above 3, no matter what 3 looks like. Most bulls will want at least a micro double bottom or a small double bottom like that. Bulls, a lower low double bottom 66, higher low double bottom 21, expanding triangle 58, then there, but a 6 bar or a 7 bar bear micro channel and 6 consecutive bear bars. And still sell the close, sell the market. Most traders are not going to buy the first reversal up. Reasonable for bears to get out 1 tick above a bull bar and maybe 5 points above a bear bar. But to get long, it's probably better to wait for at least a micro double bottom. Testing yesterday's low, which is just above last week's low. I said at the end of last week and again today, I think we probably have to go below last week's low. It was a weak entry bar on the weekly chart, and the buy signal bar 2 weeks ago did not have a very big bull body. So I think it's a less reliable setup, and it probably will require more of a test. Plus, there's the obvious issue of a possible wedge on the daily chart, and the bears are trying to get the market to go below the February 24th low. They're hoping for a big breakout below a strong attempt at a bottom, a move down to the pre-pandemic high. They know they're probably buyers below 24, but they want to find out. They want to push it below 24 and see if the bulls panic out or if the bulls will buy aggressively. They'll probably buy aggressively. What about the war in Ukraine? The market, market's not. At some point, you decide, it's a war, and it's, both sides are doing stuff. It's going to go on a long time. At some point, it becomes much less a factor. I think it's been going on now for 11 days, and at some point, it just becomes another day in the war, and traders will conclude, it's causing a crude oil market to soar, but it's not. It's already priced in. Traders don't think it's going to get a lot worse. Macron, the French president, last week said it is going to get a lot worse. I don't know. Nobody knows. But as Americans, we're not really threatened in any way. So, what did I want to show over here? I lost my thought. I'll come back to that later. Globex market, 90% chance we go above the Globex high or below the Globex low. Bulls trying to get a double bottom, a very, very strong rally. And I said we might test that low and the moving average. We're doing that now. This is the 15-minute Globex chart. The bulls are hoping to get a very strong bull bar. On the 15-minute Globex chart, it's more bullish than bearish. This is more likely a pullback from this than it is the start of a bear trend. This is a very big bear surprise bar, so we'll probably get a second leg sideways to down. And therefore, we'll probably go up and then test down again. So the first reversal up will probably be minor when you look at this 15-minute Globex chart. When you look at the 5-minute day session chart, the first reversal up is probably going to be minor. We have 6 consecutive bear bars and 8 bars in a microchannel, every high at or below the high of the prior bar. So maybe we'll bounce to the moving average. Bulls hoping this is a sell climax and that we reverse up abruptly, but probably not. We'll probably need at least a small double bottom like we had on Friday. And the bears are hoping we're going to crash below last week's low and race down to the February 24th low. But big bear bar 1, and then what do we get? 2. Weak follow through. Big bear bar 3, another bear surprise, and relatively weak follow through 4. So if you're getting a trend and it's getting big bars in it, but not consecutive big bars, there's hesitation, there's profit taking going on, less conviction, and it tends to lower the probability of a big move. I said the bulls will probably want some kind of a double bottom, or at least a micro double bottom. And therefore, even with the good buy signal bar 5, a lot of bulls, if you buy 5, what happens is this. I did not buy 5. But if you do buy above 5, you're hoping for the market to do this, right, or that. You know it probably will not, and therefore the bulls buying above 5 will be very quick to get out if we do not race up. They'll try to scalp out 5 or 10 points. If 5 did not close on its high like that, you would get bears selling 8-bar bear microchannel. But instead, you're going to get bears buying back shorts. As I said, sell the closed bears, reasonable to exit above a bull bar, especially a bull bar closing near its high. So it's reasonable to exit shorts, even though it's still always in short. Bears can sell again below a bear bar, maybe 6, maybe 7, or maybe a pullback to the moving average. Possible low of the day, but if I bought it, I would have bought small, stop below 4, and I would add on as it goes up, build the position as it goes my way. And for the bears, they want a low 1, 6, but a pretty good bull bar 5, and a test of yesterday's low. The bears will need a reasonably good bear bar to attract stop entry sellers. Confusing. And confusion is your radar telling you that we're probably going to get a trading range out of this. It went up enough for bulls to make 5 points, and then what did it do? It pulled back. Why did it pull back? Because a lot of the bulls decided maybe I better to scalp out part at 5 points because it's just not racing up fast enough. So you have bulls who bought above 5, hoping for an explosion to the upside, and then it went up, but not fast enough, and they quickly scalped out 5 points. So you had bulls selling 5 points above 5. Now, the bears are not going to sell the 5 high. They know it's a possible low of the day. But they also think the first reversal up is minor, and they want to sell. So instead of selling at the 5 high, the bears are going to sell a reversal down, maybe at the moving average with a stop, or they'll sell with limit orders somewhere above 5. So not at the 5 high, but with limit orders, 5 points above, 10 points above, 15, 20 points above, betting the first reversal up will be minor. So 5 points above bar 5, you had bull scalpers exiting, and you had bears starting to short. Those bears can exit right now with 10 points profit, and that might reduce how far down we go 6. I don't know. I said bulls who got out, I said bears who get out above 5 can always sell again below a bear bar, especially a bear bar closing near its low, possibly bar 6. But now we have 4 sideways bars at the bottom of a trading range. So that lowers the probability for bears selling below 6. 6 is also a big bar, so if you sell below 6, stop is above, you're risking a lot, and therefore you have to trade small. And that will result in fewer contracts being sold below 6. Testing Friday's low, and as I said last week, and I said today, I think we probably have to go below last week's low. Big outside down. Look at the high of 6. Look to the left. It overlapped 2, but the bodies did not overlap. So it's a breakout test. 3 broke below 2. 6 tested the breakout point to 2 high. Big outside down, but the bottom of a now 7-day trading range. And bad follow through after other big bear bars, 1 and 3. So that will reduce the number of traders selling, the market selling the close. Parabolic wedge, 3 pushes down, 1, 3, 6. I said bulls would not buy the first reversal up, but they might buy the second. If they get another bull bar closing on its high, bar 7, you will get more bulls willing to take a chance. It's the low of the day. But as I said, I think we're going below last week's low. We're right in the middle of the Globex range. Still 90% chance either we go above the Globex high or below the Globex low. But we may go sideways here a little bit. Globex low, Globex high. We may go sideways around the middle of the range as traders decide, are we going here or are we going there? We're far from both the Globex high and the Globex low. We're about 40 or 50 points from both. and we're in the middle of a very big Globex range. And twice a month, approximately, the market does not break out of the Globex range. Today is that kind of a day where we might not break out of the Globex range. So I'm saying 90% chance we break above the Globex high or below the Globex low. It's, I think, less than that today. We're in the middle of a very big Globex range, so maybe 70% chance we'll break below or above. And if we start to go sideways for a lot of hours, it could become 50% chance after a few hours. The bears who exited above 5, they could sell again below a bear bar closing near its low 6, or at a new low on a stop below 4. Those are two ways to get back short again. But I would get out 5 points above any bar, 7. I would get out above a bull bar, 7. And if 7 is a big bull bar closing near its high, bulls will buy, taking a chance, parabolic wedge, 1, 3, 6, and fail breakout yesterday's low. Also, you could argue wedge, 1, 2, 3. You can see the bad follow through. So if you're a bear, you're frustrated. You get 2 and then 4. You get good bear bars, 1, 3, 6, but weak follow through. So it's not relentless selling. The bears are not being aggressive. Bears are selling, taking profits, selling, taking profits. That happens more often if the sell-off ends up reversing or converting into a trading range. It happens less often if the sell-off is going to last all day. Possible low of the day, parabolic wedge, 1, 3, 6. Decent bull bar, a high 2, failed breakout yesterday's low, reversal up from just above last week's low. So bears should get out. Bulls, it's reasonable to buy, but if you buy, I would buy small and then add on if it keeps going up. Bears are selling at the market, trying to prevent 8 from going above 7, because if it goes above 7, a lot of bears will buy back shorts and bulls will start to buy, and this could end up as the low of the day. So the bears are selling the close of 6, even though it's a bull bar. Parabolic wedge, 3 pushes down, 1, pause, 2, pause, and then 3. Similar to today, the 3 are not obvious. Could be 1, 2, 3. It could be 1, 2, bounce, and then 3. Bull bar closing near its high. Bulls will start to buy, taking a chance, low of the day. Similar to today, 3 or 4 pushes down, 1, pause, 2, pause, 3, pause, 4, pause. Maybe the count started over again here, so maybe it's 1, 2, and then 3. And then bull bar, tail, not a high probability buy, but a reasonable buy, and that's similar to today, a reasonable buy. You can always buy more if the reversal keeps going up. 3 pushes down, 1, pause, 2, pause, 3. Bulls will start to buy above bull bars, especially if we get 2 or 3 bull bars. Here, the tiny parabolic wedge, tried to bounce, and then a third time. Very often the bottoms just don't look all that good. Here, you got 6 bear bars, 7 bear bars, yet it's still a swing buy. So it's reasonable to take the buy. A lot of the parabolic wedge bottoms do not look good because you're buying in a tight bear channel, similar to today. Bounce. So first leg down is a gap, and then second and third. Bull bar closing near its high. First leg up, when you have a tight bear channel, usually it's minor. So if you do buy and you get 10 points, it's reasonable to take part off. Should you exit at 5 points because above 5 it only went up 5 points? Will today be a 5-point scalp day, or is today a 10-point scalp day? We don't know yet, but we do know this is not racing up. And we also know it's a tight bear channel, and therefore the first reversal up will probably be minor. Minor means it goes up and then we go back down. It becomes a bear flag, or it's the start of a trading range. So sometimes it'll go up and then just go sideways. And then here, at some point, we got a higher low major trend reversal and a strong bull breakout. But the first reversal up was minor. Instead of leading to a bull trend, it led to a trading range. From that trading range, we then got a bull trend here, but we could easily have gotten a resumption of the bear trend. Bulls want to get this, but so far we're not getting that. Consecutive big bull bars closing near their highs. Instead, we're getting hesitation. You got limit order bears selling above. But we did not even go up 5 points. So, it's not doing what recent days have done. The moves are too small. So, further increasing the chances that we're going to have a lot of trade range trading. Disappointing moves. Disappointment for the bulls, disappointment for the bears. And disappointment is one of the hallmarks that the market could be evolving into a trading range. For the bears, a low 1, a low 8. They want to break below last week's low. I said I thought we would do it. I'm not sure we'll do it now. Let me say one other thing about the bulls that bought above 7. Oh, terrible entry bar 8. So a lot of those bulls are going to exit break even 9. And then they'll wait to see if 9 is a big bull bar closing on its high, and they'll buy more. Whenever you're buying in a bear trend, if you're disappointed, it's reasonable to just get out, around break even. You can always sell, you can always buy again later. For the bears, it's a low 1, but 2 bull bars at the bottom of a 7-day trading range. And there might be more buyers than sellers below 8, below 7. I did buy above 7, and I exited with a few ticks profit during 9 after seeing 8. Now, the sell to close bears, they're not going to sell below 8 consecutive bull bars parabolic wedge. They might sell below 7, hoping on a failed bottom and a quick move down. It's reasonable to be long, stop below 7. It's reasonable to exit longs, or it would be easy. I would not exit longs here, right? You either exited during 9 when it was above 7, or you exit below 7. What about buying more below 7, betting on a new parabolic wedge, 1, bounce, 2, bounce, 3? There probably are buyers below 7 and buyers below last week's low, but I would rather buy with a stop because we could get quite a bit below last week's low. Why is that? Because of what I said about the daily chart. I said the market may come all the way down and test that January 24th low again, and also a 50% correction. So here's 50%. So that's a reasonable magnet. So somewhere between 50% and here, I think is a reasonable buy zone. Can you sell below 9 if it's a higher low? I would not. I think you either sell below 7, or you wait for a bear bar closing below 9 and then sell below that. Because I want to buy stocks for a trade, I just took a quick look at a bunch of the stocks that I'm following. You can always, if you want to buy tech, the first thing you look at obviously is Apple. But so far does not look good. This is the daily chart. Apple, Microsoft, another very strong tech stock. And bulls need a reversal. They're not getting it yet. NVIDIA, obviously another strong tech stock. Or you can also look at Cathie Wood's ARC, which is a collection of tech stocks. and it's down, whatever that is, 60% or more from the high. It has a bunch of tech stocks in it, including Tesla. So instead of buying Apple, Nvidia, and Tesla, and who knows what else, you could just buy this. It's a collection. It's mostly, I don't know how many stocks are in it, but it's mostly about 10 tech stocks. So it's the equivalent of buying 10 tech stocks. So I will buy ARK probably if we got another day like this. I did buy it last week when I was doing that. Cryptocurrencies, they're, I think, highly correlated with the stock market at this point. Here's the GBTC. It's an ETF. Here's BITO, another ETF. That's not what I want. I guess I don't have it on this computer. I'll put it up. But, you know, it's highly correlated with the stock market. So it's just more levered. So you can always, so trading cryptocurrencies is similar to trading stocks. Here's the ARKK ETF. You know, very similar pattern. Here's the NASDAQ. Not as violently down. A lot of traders, instead of buying tech stocks, instead of buying Apple, you know, a basket of tech stocks, they just buy the triple Qs. Here's the QQQs. Can we go down all day long like this? Bad follow through, big bear bar, bad follow through, big bear bar, bad follow through. Probably not. That bad follow through increases the chances that we'll get a reversal. It increases the chances that this sell-off is a bear leg and what will end up as a trading range. Trading ranges have bear legs and bull legs. So this relentless bad follow through increases the chances that we're going to get a swing up. The swing up, it could lead to a bull trend. It could lead to a trading range. Another bear surprise, but now the possible parabolic wedge is 1, bounce, 2, bounce, 3. If 10 closes on or near its high, it would be another buy for another possible parabolic wedge. Reasonable to trade small. You're buying in a tight bear channel. The reversal up will probably be minor, but if it surprises you and rallies strongly, you can buy more as it goes up. For the bears, I'd get out above bull bars 5 and 7, and you can always look to sell again below the bear bar, but the sells are not all that good, below 4, below 6, below 7. So there's something wrong with the bear trend, and what it is we're getting terrible follow through. Parabolic wedge, but only a doji. That is not going to attract a lot of buyers above 10. I would get out of shorts above any bull bar, even a crummy one like that. You can always sell again if we get another bear bar. Now, since it's not a strong buy signal bar, some bears will not exit one tick above 10, even though it's a bull bar. But they will exit at some number of points above 10, so maybe 5 points above 10. You can get out one tick above 10 because of a parabolic wedge, 3, 6, reasonable to get out, possible low of the day. Bulls, some bulls will buy this, taking a chance it's the low of the day. Others will wait for a bull bar closing on or near its high. Confusing, right? There are several ways to do it that are reasonable, but reasonable to get out. If I were short right now, I would get out above 10. And for the bulls, you could buy above 10, but I would buy very small and add on higher. You could wait to see if 11 closes on or near its high and buy above 11. Sometimes you'll get a sell climax and then II, consecutive inside bars. I like that. And that has okay, we're not going to get an II. 11 is not an inside bar. But some bulls will wait for a bull bar closing near its high and buy that, so possibly 11. We're getting near the end of the first hour. So what happens, 11 and 12, affects the appearance of the 60-minute chart. And for the bears, they're trying to get a breakout below a trading range, 7-day trading range. Okay, breaking below. I'm saying 7 days. This is part of the range, so it's 8 days. They want to measure move down. As I have been saying, I think we might have to test 4,200. I suspect we will not reach the measured move target. This is a 60-minute chart. What do you do right now? You can be short. You can just sell at the market. I would not. We're getting bad follow-through and a lot of reversals. So that lowers the probability. However, the best shorts today were limit order shorts. And that is usually not the way strong trend days behave. Strong trend days usually get a lot of good stop order shorts. And we're not getting that today. Selling below 6, a huge bear bar. Selling below 9, selling below bull bar 5, selling below a bull bar 8, bull bar 10. So this is not behaving the way strong bear trends behave if they're going to last all day. So bear trend, but not there are problems with it. I talked earlier about a possible measuring gap too low. We're already beyond that. Bulls trying to get another buy signal bar. If they get one, the bigger, the better. The bigger, the more it closes on its high, the more bulls will buy above it, and the more bears will buy back shorts. First reversal up, probably minor, probably a bull leg, and what will end up as a trading range for an hour or two. Is this a small pullback bear trend? Well, it's a bear trend, and the pullbacks are small, or at least brief. 1 bar, 1 bar, 1 bar. So it's a small pullback bear trend, but it's also fairly climactic. We've had many big bear bars closing near the lows here, 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 and here, and then even here as well. And we're not getting, those big bear bars are attracting a lot of profit takers, bears quickly taking profits. And bear trends that last all day usually do not have quick profit taking. Normally you'll get sustained selling, 2 or 3 or 4 consecutive bear bars. Bears are trying to get down to the Globex low. It's getting within reach. Bulls will try to prevent the market from falling below that low. We're back in the overnight trading range, increasing the chances that we'll start to convert into a trading range. Traders are selling for any reason, but the bad follow-through tells us that the bears are taking quick profits. So they lack confidence that this is going to last all day. If it's going to last all day, you don't take profits after a big bear bar. Big bear bar means, oh, I have big profits, and then you're taking profits. That's not what bears typically do if they're confident the trend is going to last all day. They see a big bear bar, they sell more. Instead, we're seeing a big bear bar and we're seeing profit taking. First time all day, consecutive bear bars closing near their lows with decent sized bodies. That's the end of the first hour, and we just traded below the low of the first hour. Bulls still trying to get a parabolic wedge reversal. Now the spike is 6, first leg 6, second leg 9, third leg 11, 12. To buy, the bulls want a decent sized bull body, and they'd like the bar to close near its high. Bears, they can get out several points, 3 points, 5 points above a bear bar 12. They can get out 1 tick above a bull bar, maybe 13 if it's a bull bar. And the bulls want to buy, but they want to buy as good a bull bar as they can get. If 13 has a big tail on top, some bulls will buy, others will wait to see what 14 looks like. How's that up but tail? Reasonable for bears to exit above 13. And for the bulls, it's a possible low of the day, but really not ideal. You know, a lot of bulls will wait to see if 14 closes on its high and then buy above 14. So some bulls will buy 13. Others will wait to see if 14 closes on its high. I think that's a higher probability bet. Market's deciding, have we put in the low of the day? Well, it's not convincing. And for the bears, it's a low 1 in a small pullback bear trend, but terrible follow through after bear bars. Still trying to get some kind of a parabolic wedge bottom. It's still always in short, and it's still a small pullback bear trend. But why are we not getting better stop entry sell signals? Typically, in a strong trend that's going to last all day, you get stop entry sell signals. Here we're getting limit order sell signals, selling the 12 high, maybe selling the 14 or 15 close. And also the bears are having a hard time holding short because we keep getting pullbacks. So I still think this is not going to last all day. If you're not short, I think that's okay. Nothing has changed. Bears get out above a bull bar closing in its upper half or near its high, and bulls will buy, but they'll probably buy small and add on, or bulls will wait to see if we get 2 consecutive bull bars. Now, you know the market often tries to reverse between bar 16 and 20. Well, this is bar 17. Globex chart, a very big reversal. The question is this a reversal into a bear trend or a deep pullback in a bull trend? And right now it's both. We don't know which it will end up being, but we're still above this low. And this is an exceptionally big reversal after such a strong rally. That reduces the chances that we're going to keep going down. We have big up, big down, creates big confusion, and big confusion typically results in a trading range. And look what we did at this price overnight. So I suspect we're going to bounce soon and start to go sideways. It's very common when you have a bear trend from the open for it to sell off for an hour and a half or 2 hours and then enter a trading range. When you have a bear trend from the open, 3 things can happen. It can last all day, you can get a reversal, or it can convert into a trading range. And this is the most common of the 3 things. So sell off for an hour and a half or 2 hours and reversal up, but didn't go up very much. It just stopped going down and sideways for several hours. This is what is most likely. Sell off and then sideways. Sell off, try to reverse, sell off again, sideways. Sell off a lot of bars, sideways. Very strong sell off, very strong reversal up, sideways. Big sell off, very big reversal up, big down, big up, big confusion, and then big trading range. Big sell off, big reversal up, end of the selling, not the start of a bull trend. Sell off for an hour and a half, 2 hours, reversal up, but not into a bull trend. Instead, a trading range. So that's what is most likely. The bears want the bear trend from the open to last all day. I don't know, at this point, I would say, 25% chance that it's going to be one of those huge bear days that just keep selling off all day. 75% chance it'll either convert into a trading range or reverse into a bull trend. And it's more likely to convert into a trading range. 3 consecutive bear bodies getting bigger, so bears becoming more aggressive, but a lot of overlap between adjacent bars. So that's still hesitation. You get a sense that there's some buying going on. 4 sideways bars here, and then tails on a lot of bars. Every tail means the market went both directions. And even here, tail up, that means we went up. So even though the tail's on top, we still went both directions. Bears, I'd get out above a bull bar closing above its midpoint. And for the bulls, I think you'll start to get bulls buying. Even with that pretty big tail, you can always buy small. If you want higher probability, you wait for a second bull bar. So I'm going to buy small above 18. You can either buy small above 18 and exit below 18, or use a wider stop and buy more at the 18 low and buy more lower. Most traders should not do that. If they buy above 18, they should get out below 18. If you want higher probability, you wait to see if 19 is a bull bar closing near its high, and then you buy above 19. For the bears, it's still sell the market, sell for any reason, but you can see there's less selling going on over the past 7 bars. We're getting a lot of overlapping bars and more neutral bars, 13, 14, 18, even 15 is fairly neutral. Bears trying to prevent the market from forming bull bars closing near their highs. They're trying to prevent the market from going above bull bars, especially bull bars closing near their highs or above their midpoints, like 18. Bears, I would get out above 18. You can always get out 5 points above 18, or wait to see if 19 is also a bull bar, but closing near its high and get out above 19. It's still more bearish than bullish. We're still getting lower highs and lower lows on every bar. So there's still more selling than buying. But the selling over these 8 bars, 7 bars, is not as strong as the selling over the first 12 bars. So there's a transition going on from a strong bear trend into a weaker bear trend, and we'll probably transition further into a trading range. Again, when you have a bear trend from the open, you got 3 things that can happen. It can last all day, maybe 20% of the time, it'll last all day. It can reverse, and I don't know, maybe 20% of the time it reverses, but most of the time, more than half the time, you get a reversal that's minor and it leads to a trading range. So most often, any strong trend on the open, after a couple hours or so, will stop trending and the market will start to go sideways. So the opposite is true in a bull trend from the open. Most of the time, it'll transition into a trading range. The trading range could last for a couple hours, and then the bear trend can resume down. The trading range could last a couple hours, and a bull trend could, you could get an upside breakout in a bull trend, or the bear trend can last all day. But at a minimum, we're probably going to get a couple hours of sideways trading starting soon. Possible low of the day, but if you trade it, better to trade small and then add on if we start to get bull bars closing near their highs. And bears, as I said, I would get out above a bull bar closing above its midpoint, 18. You can always sell again if we get a bear bar on 20, or you can sell on a stop below 18, but that's not good because selling at the low all day, the bulls have been making money. So they bought the 4 low, bought more lower, and went back above the 4 low. They made money. They bought the 2 low, they bought more lower, and went back above the 2 low. 7 low, they bought the 7 low, bought more lower, and went back above the 7 low, they made money. All day long, limit order bulls have been making money. In a bear trend, it's usually difficult for bulls to make money. But right from the open today, the bulls have been making money buying below everything. They don't necessarily buy the 4 low. Some buy the 4 low, place a limit order to buy more, 5 or 10 points lower. Others say, yeah, it's a reasonably strong bear trend. It'll probably fall 5 or 10 points below. So why buy the 4 low? Why not start to buy 5 points below? And then they make 5 points, they make 5 points, they make 5 points, all the way down. Bears giving up. Who's buying 20? Is it mostly bulls getting long, or is it bears giving up? It's mostly bears giving up. Now, they saw we had a bull bar 5, a bull bar 7 closing near its high, and they were able to make money selling above, and the market quickly turned down. So far, this is not quickly turning down. So the bears are not selling 5 points above 19. So who's buying? The bulls who bought early. They either bought with a stop above 19 or above 18, and then they'll wait for 20 to close before they buy more. So the people buying right now are mostly bears exiting. This is probably the start of a trading range. The trading range could begin on 20 and start to go sideways, or we could go up for several bars and start to go sideways. We have an obvious important price, low of last week. So we're probably going back above the low of last week at some point today, possibly in the next few bars. It's possible we'll just go sideways for an hour or two and then above that price. Now, why did it stop exactly right there? Okay, think about it. Okay, some bulls bought 1 tick above 19, and they want to take partial profits at 10 points, which is 40 ticks, and it has to go 42 ticks above 19 for them to make their money. It just went 42 ticks above on bar 21. The high of 20 was 41 ticks, and the reason why it stalled there is there were a lot of limit orders from bulls trying to take partial profits at 10 points. And they were able to get their partial profits 21, and that's why we're hesitating here. So you get some bulls taking partial profits. Now, I said some bulls would add on as it goes up, but adding on right below the moving average is usually not a good idea. So it's better to take partial profits and then wait to see what we get. For the bears, they're hoping it's a double top bear flag 14, a 20 gap bar sell. We've been completely below the moving average for about 20 bars. And that means bears have been willing to sell far below the average price. Now they're finally getting an opportunity to sell at the average price. So you'll get some bears selling. And you'll get some bulls taking profits. I did take partial profits at 10 points. Now, bears want a double top 14. They want a good sell signal bar, so they want 21 to be a good sized bear bar closing near its low. If they get that, a lot of the bulls who bought above 19 will exit, and bears will short, betting that will break below the neckline. We have a double top 14-21 neckline. So some bears will sell below 21 if it's a bear bar closing near its low, betting we break below the neckline and fall for a measured move down. If 21 does not close on or near its low, there probably will be bulls buying at the low of the bar and 5-10 points below, betting that we'll get a higher low and a second leg up. This is the climactic sell-off. When you get a reversal up from a climactic sell-off, you're typically going to get at least a couple legs sideways to up. We have a bull surprise bar at 20, and the bull surprise typically will have the second leg sideways to up. It's not a huge bar, it's not closing on its high, but chances are we're going to get at least a small second leg sideways to up. Very tight bear channel, so pretty persistent selling. I talked on the 15-minute Globex chart that we're back into a range where we were sideways for 5 hours, 6 hours overnight, and I said we might go sideways here. We have big up, big down, big confusion. That usually results in a trading range. We have a bear trend from the open, and typically you get a reversal up and then a trading range. The reversal up could be just a few bars and then a trading range. It could be many bars and then a trading range. Just like the follow through after big bear bars was disappointing for the bears, this is disappointing for the bulls. 20 is not quite as big as the bulls want. They certainly don't want it stopping at 10 points because that means the bulls are scalping out. The bulls are not buying more at the high. They're selling at the high. They're doing the opposite of what the bears did on the way down. Bears double top 14. And some will sell below 21, taking a chance. But chances are there's going to be something wrong with 21. The tail will be bigger than the bears want, probably. Double top bear flags, most of them do not look like they'll be successful, but they work a lot of the time. If you get a, okay, here's a double top, two different double tops. Sometimes the second leg up is very strong, a bi-climax. More often, the second leg up has 2 or 3 subdivisions in it, like a wedge. So when you have a double top, second leg up, a third of the time it's very strong, a bi-climax, and you go straight down. 2/3 of the time it's like a wedge rally, a weaker rally, and then you go down. A lot of times you have a strong bear trend, a strong reversal up, and it just goes down like this. And this is what the bears are hoping will happen today. 40% chance if you get that bear bar near the moving average and you sell below the low of the bar, you're going to break below the neckline of the double top and fall for about a measured move down. Reversal down, we have a double top, it became a wedge top, and we got a reversal down, far more than a measured move. Strong reversal up, look to the left, maybe it's a double top. And we broke below the neckline and fell for about a measured move down. This is what the bears want. Now, a very good looking bear bar closing near its low. Why would bulls buy the close of 21? Because they're hoping this is the low of the day. And they need to show signs of strength. If it falls below 21, that is a sign the bulls are not strong. Now, why are we going to fall below the 21 low? And we are. All right? Why do I say that? Because 19 is a bad-looking buy signal bar. And usually if you get a bad-looking buy signal bar, bears will sell the high and sell more higher, 5, 10, 15 points higher, or at the moving average. Or they'll start to sell, 5 or 10 points higher. Instead of selling at the high, they'll sell higher, betting that we have to test the high of the bad buy signal bar. So chances are we're going to go below the high of 19 by 1 tick. Bulls are trying to prevent it. They're buying the market, trying to prevent the sell signal from triggering. Do you have to get out of longs below 21? I would. You can always buy again if 22 or 23 is a bull bar closing near its high. I said we should drop below the 19 high. And that's true even if we go above 21 and above the moving average. And, we could get below that high an hour or two from now. Remember, a trading range is most likely. So we could go up for many bars before we test that high. For the bears, a micro top, resistance of the moving average. So you get bears selling around the moving average. They sold the close of 20. They sold the high of 20. They sold with the limit order just below the moving average. All those bears made 5 points. So they're selling again. Bulls want a strong break above the moving average, and they want a small pullback bull trend. After a very tight bear channel lasting a lot of bars, this first reversal up will probably be minor. Minor means a bear flag or sideways trading range. So bears, it's a short below 21. I'm not going to take it. Bulls, they're still long, reasonable to take part off at 10 points, reasonable to exit below 21, although you could instead get out below 18. And to buy more, at this point, I would wait to see if we break strongly above the moving average and then buy higher. Bull surprise bar, 20. Expect second leg sideways to up. 22 meets the minimum. And for the bears now, it's a micro double top, 20, 22, and a decent sell signal bar. So it's a sell, but it's a swing sell because it's a low probability sell. Bulls, I would get out below 23. If it's going to be a bull trend, it'll probably last 20 or 30 bars. It doesn't matter if you enter late. And for the bears, double top 14. You can call it a wedge, 3 legs up. Whenever you get a double top, a breakout that fails, you have 3 pushes up. 1 pullback, 2, creating the double top, and then the failed breakout above the double top. So it's a 40% short, 40% chance we go below 18 and fall for a bottom measure move down. 60% chance not. Remember, trading range is most likely. However, for the bulls, I would not hold long below 23, a micro double top and a double top at the moving average in a bear trend. The issue is whether to go short. We're still always in short, so traders who want to be always in the market will sell this. Remember I said we should dip below the 19 high. That's why I put that line there. And the bears hope that we not only get below that high, that we break below the 18 neckline and go down for a measured move. And that part, I think, is less certain. As I said, 40% chance we break below and fall for a measured move. Most likely, 13 is the start of a trading range. When we look back a couple hours from now, if we're in a trading range, which is likely, we'll say, it began with those dojis back there, 13 and 14. Whenever you have a bear trend, or any trend, and then you start to get dojis, that often is the start of a trading range. It's a warning that the trend is not as strong. You can say, well, Al, 4 is a doji, 10 is a doji. Isn't the trading range starting over here? Well, it might be. The top of the range might be here. We don't know yet. But it's clearly not strongly bearish right now. Just look at the past 12 bars. Okay, when you look at this, you say, wow, what a strong bear trend. Of course not. And you say, what a strong bull trend. Of course not. All right. So what are you left with? A trading range. Right? It's a trading range. On a short below 23, but probably a minor reversal. So if you're a bear and you sold below 23, what are you thinking? You're thinking, darn, I wanted a bar like 9, instead I got a bull doji, right? Confusion, disappointment, trading range since 13. And for the bulls, you're hoping we're getting a bull trend reversal, so you're hoping this is the beginning of a small pullback bull trend, and you're hoping 21 is a small pullback, 24, 25 small pullback. But you don't want to buy above a doji 24 right below the moving average after 2 big bear bars. Remember, we should fall at least 1 tick below the 19 high. The bears want a measure move down below 18. Is the bear trend resuming? 40% chance, maybe 50% chance after seeing 25. But 50% chance we're in a trading range since 13. Now, are the bears going to buy back shorts? The bears who sold the 19 high and sold more 5 points higher, 10 points higher. Are they going to conclude we're in a trading range and therefore they buy back their shorts since we're near the bottom of it? Or are they going to add to their shorts, betting that we're going to fall for a measured move? We'll find out over the next few bars. The more bars close on or near their lows, the more bears will sell closes and sell below bars, betting that we're going to break below 18 and fall for the measure move down. Remember, these double tops never look like they're going to go down for a measured move, but 40% of the time they do. Anytime you get a reversal and it starts to resume down, look to the left. If it's a double top, it increases the chances that we will go down. Here, this is a big double top, strong sell-off, tried to reverse a second time, look to the left. Maybe it's a double top. Maybe we'll fall for about a measured move. Here we fell for much more than a measured move. Double top, bear flag, tried to reverse again, look to the left. Maybe it's a double top. And we fell for a little bit more than a measured move. And then began the trading range. And this ended up as part of the trading range. Even though we went lower, it still ended up that the trading range began over here. Breaking below neckline, double top. Will bears buy back shorts with about 10 points profit, which would result in a bounce in their trading range? Or are they going to sell more at the 18 low, below 25, below 26, leading to a measured move down? When you have a double top with two different highs, I always look at a measured move based upon the lower of the two highs first. And if it falls below that, then I'll look at a measured move from that. Bears want consecutive closes below the neckline. That would increase the chances that we go at least to here. It's sell the close. You can always get out above a bull bar 27. If it's a decent sized bull bar, bulls will buy for a lower low double bottom. Very close to the Globex low, so probably will fall below it. Bears, I'd get out above a bull bar, closing near its high, especially if it's a pretty big bull bar. If it's only a small bull bar, you can get out 5 points above. Sometimes double tops fail. So sometimes you get a double top bear flag, a break below the neckline. We're here, double top bear flag, and we didn't break below the neckline, we just formed a higher low. Double top bear flag, got near the neckline. Small double top here, broke below the neckline, reversed. A lower high double top, maybe a higher high double top here, broke below the neckline, reversed up. Double top here, we're right at the end of the day, but we tried to reverse down, broke above the double top. And at a higher low, broke below the trading range and reversed up. Bulls want as big a bull bar as possible, especially after consecutive big bear bars closing near their lows. And since we're probably going below the Globex low, a lot of bulls will not buy above 27. So bears, will they sell above 27? If it's a bull bar closing near its high, I think a lot of the bears will get out, even though we have a magnet below the Globex low. If it's only a one-tick bull doji or a two-tick bull doji, bears might sell above, but there's probably not much left to the downside. Globex low. Bulls trying to get a double bottom with this earlier low, the bottom of the spike climax. The bulls will get long. They'll buy above 27 if it closes near its high. Because of the two big bear bars and the Globex low just below, bulls buying above 27, better to buy small and then add on if it goes up. If the body is this big or bigger, you will get bulls buying. But if it pulls back and we get a prominent tail on top, it's better to not buy. Wait for a second bull bar. Chances are we're going lower. We're right above the Globex low. Okay? That's what I was talking about, that if it pulled back a little at the end of the bar and had a small body and a prominent tail, that will reduce the number of bulls buying. It's a bull reversal, but is it a strong enough foundation to build a bull trend, especially after those two big bear bars? And right now, it's probably not. So, possible low of the day, more likely we're going to go lower. Bears can exit. They can exit 5 points above, 10 points above, or they can exit all the way above 22, which is, nobody wants to risk that much. And some bulls will take the buy. Others will wait to see if we get 2 or 3 bull bars and then buy. Big tail, so you can see a lot of the bulls scalped at 10 points, and bears sold near the moving average, betting the bear trend will continue. I would be out of shorts, and I think it's okay to be long, but it looks like a lot of the bulls scalped out when they got their 10 points. Since we're always in short, can you still be short? I would be out of shorts above 27. And if we get a bear bar 29, bear bar closing near a slow, you can always sell again. You could sell below 27, but what I've been saying for the past hour, I said we probably started a trading range 13. And if you're selling below 27, you're selling at the bottom of the trading range, similar to selling below 18. Bulls buy and they buy more lower. So they're probably buyers, more buyers than sellers at the 27 low or 5 points lower, 10 points lower. So if you take that sell, you can only do it for a swing. If there are probably buyers below, that means it's probably a losing trade for the bears. If you're taking a trade where you're probably going to lose, you can only take the trade if you hold for a big profit, a swing. So bears selling below 27 are swing bears. There might be more bulls buying below 27, buying below a bull bar 28. Right now, the market's deciding what to do with the Globex low. Chances are we're going below the Globex low. That's below this low, so we're probably going at least a little bit lower. Another low one, closing near its low. We should go lower. Bulls will try to get a second reversal up, a higher low. I would get out of longs here. And bears, there's probably not a lot more to the downside. So if you're taking this short right here, you have to be swing trading, hoping that we go a lot lower. Remember, there's a 40% chance we get all the way down here. It might be 50% at this point. We have to stop at the Globex low? Absolutely not. We could fall far below it. This is the 15-minute Globex chart. But it's a high probability. It's becoming increasingly higher probability that we're going to get below it. Bulls trying to get a second reversal up. Remember, some bulls bought above 27 and put a stop below 27, so they're buying more here, just above 27, trying to prevent their stop from being hit. And if you're a bear and you sold below 29, you want the market to collapse. And if it doesn't collapse, excuse me, you'll buy back your shorts. So if enough bears buy back shorts and enough bulls add to their longs, we can get a second reversal up. To buy above 30, the bulls need a good bull bar. Does not look like they'll get it. So it looks like we're going to go below the Globex low. We're right above the Globex low, and we're probably going below it. Sometimes it'll go right down to the Globex low and reverse up. Usually, if it gets near the Globex low, it's going to go below it. Broke below the Globex low. 90% of the time, we either break above the Globex high or below the Globex low. Here, just a look, we went above it and below it. Here, we tested it, could not get above. Tested it, could not get above. So sometimes it will get exactly to it and not break through it. And today, that's what the bulls are hoping will happen at the Globex low. Here we broke a little bit below it, reversed up. Here we got near it, but could not get below it, reversed up. Got near the Globex low, could not get below it, reversed up. So sometimes it'll get very close to it and not break below it. But most of the time, if it gets close to it, it'll break below it. Okay, we just broke below it right now. We're also around the measured move from the double top. So 2 reasons for bears to take profits. We're at 2 targets, the Globex low and the measured move. For bulls to buy above 31, they'll need as good a bull bar as possible. A 1-tick bull body, 3 or 4-tick bull body, that's not going to attract many buyers. If you have a bad buy signal bar, a lot of bulls will wait for the next bar to see if you then get a bull bar closing near its high. And the bears, they're hoping the small pullback bear trend lasts all day. I still think we're probably going to evolve into a trading range. And the top of the range is up here. But for the bulls to buy, they need a good bull bar. Bears, I'd get out a tick above a bull bar closing above its midpoint, or 5 points above a bear bar. And for the bulls, they need a good buy signal bar. If they do not get one, they can wait for a second bar. That's what I was talking about. 27 did not look big enough to reverse those 2 much bigger bear bars. This is what the bulls want, but this is rare. A very good buy signal bar and a very good follow through bar. 2 big bull bars closing near their highs. That's rare. Good looking bull bar, good looking bull bar. We're not getting that today. Here, not a good buy signal bar, not a good buy signal bar. But after this, you will start to get bulls buying above that. Disappointed, they might get out. And then here, a big bull bar closing near its high, they buy that, they buy that. Here, not a good buy signal bar. Bulls will wait for a bull bar closing near its high and then buy above that. Not good buy signal bars here, but okay to buy that. Right now, it's still sell for any reason. The bears hope this will last all day. It's becoming increasingly bearish. We have consecutive bear bars here, 3 consecutive bear bars here. Not much overlap, not much overlap. So the bear trend is becoming stronger. The bulls tried to end the bear trend here, failed. The bears are strongly in control again. 3 decent-sized bear bars. A lot of bulls will want a micro double bottom before they buy, or a very strong buy signal bar, or 2 or 3 bull bars. And for the bears, they're still shorting, betting the bear trend will last all day. Bulls, it's a small wedge, 1, 2, 3, but they need a good buy signal bar, 32, or 2 or 3 bull bars. Bulls are hoping that The big bear bar is simply a pullback from the double bottom. The bulls have a double bottom and a big bear bar, and they are hoping they can get a higher low major trend reversal after a double bottom major trend reversal. They would like this to be a higher low and for the market to continue up. We're still getting lower highs. We're probably always in short. The bulls, a lot of bulls were hoping 58 was always in long, but it didn't break far above the moving average, and it did not break above 51, so we still have lower highs. Trading range since 32 or 36. When you get these bear trends from the open, more than half of them start to go sideways, and you spend the rest of the day mostly sideways. And where did it start going sideways? Well, this is possibly the top of the range, So you can say that's the start of the range, or this is the start of the range. Well, the bear's a low one below 60, but just above the bottom of the trading range, and that's a low probability sell. It's breakout mode. Some bears will sell using a stop below 56. Others will wait for a close below 56 and then sell, or they'll wait for two closes below 56 and then sell. We're probably not going to go very far up or down. I've been talking about the January 24th low for since the reversal up on February 24th. I said that we might have to come back down and test that low. It was a very important price. The market reversed up violently at that time. We gapped far below it here and reversed up violently again. But this bar is so far above that low, nobody wanted to risk that much. So a lot of bulls did not want to buy here, but they wanted to buy. So they wanted to wait for a pullback, maybe a test of a price where the market reversed up violently twice, here and here. And that's why I said we might have to come back down there. Also, it's a little bit more than a 50% pullback, and the market likes 50% pullbacks. Right now, the market traders are deciding, is the bear trend continuing, or is 24 going to be the low? I still think 24 is more likely going to be the low for at least the next several months. But if we get another day tomorrow, like today, then you're going to be thinking, maybe we will break below 24. Difficult to do anything when it's like this, right? I tend to sell below bear bars like 44 or 51 at the top and buy above bull bars at the bottom, 47, 56, take quick profits, hope for a breakout. When it's clear I don't get it, I get out of the rest of the position. I did not sell below 60 because of the three bull bars 58 and the possibility of a double bottom pullback. But I'll need a bull bar 61 or 62 to buy. Very often when there's a double bottom, there's a sharp sell-off that fails to get below the double bottom, and I call it a double bottom pullback. If you get a bull bar closing near its high, it's a buy. Very common pattern, double bottom, you can buy that. If you get the attempt to reverse down, you can buy above that bull bar, or above that bull bar, or that bull bar. Hoping for a swing up. Here we got a double bottom, a break above the neckline, and then a fairly sharp pullback. Bulls will start to buy above bull bars, hoping for a swing up. A double bottom, and then a pullback. Bull bar closing near its high. Not great to be buying that high, but if you want the higher probability buy, that is better than buying above these dojis. Double bottom, pullback. Sometimes you get 2 or 3 attempts to reverse up from the higher low. Here's a higher low double bottom and a pullback. It's also a triangle. Double bottom, pullback. Bulls buy, hoping for a swing up. And double bottom pullback, but not a bull body, so it's not worth buying. and for the bears, a low one, but right above the bottom of a trading range, and I think not a very good sell. I think the bears need to sell higher, or they need to wait for the breakout below the double bottom. Everybody sees the magnet, the 24 low, right? Every trader on the planet is aware of that. And the debate is, are we going to break below it, or is it going to remain support? The last time we tested it here, we gapped way down below it, so we broke far below it. This time we're testing it again, and if the bulls are very, very eager to buy, it may not get below it. We may simply reverse up from above that January 24th low. Another reason why we've been sideways we've been sideways, you can argue sideways since January 24th, but sideways here. Another reason is we have an FOMC meeting next week, next Wednesday on the 16th, and there's some uncertainty about whether the Fed will raise rates a quarter point or a half point. I would raise rates a half point, but Powell has been very lax. He's been very pro expansion of money, so I think he's only going to raise the rates a quarter point. And my guess is I'm not the only person who believes that. I think most institutions believe he's only going to raise a quarter point, and that throughout the year, every FOMC for the next several, they'll raise a quarter point. Bulls need a bull bar, preferably one with a decent sized body closing near its high. That would be a buy. And bears need a breakout below the double bottom. But as I said, even if we do break out, we have exhausted bears. They sold strongly for 3 hours, 2.5 hours, and sideways. And sometimes you'll get trend resumption down, but usually not. This is a sell-off getting down to an important price, and then the market stops and decides, will it get through it or will it reverse up? We had a bear trend from the open. And I said there were 3 possibilities: that it lasts all day, 20% of the time, that we get a big reversal up, maybe 20% of the time, and then 60% of the time, it transforms into a trading range. And sometimes the market will drift up from the trading range, sometimes it'll go down a little bit more, but usually it just stays mostly sideways. Here we got a reversal up. Here the bear's got a little bit of resumption down, but usually it's not going to go all that far one way or the other. Here, sideways for a whole bunch of bars, went down a little bit and then back up. This is what the bears would like, but it's too late in the day, so we're probably not going to get a big breakout like that. Same thing. Well, here, I don't think this is as extreme as today, so not as exhaustive, but the bears are hoping for trend resumption down. Most likely, we're going to stay essentially sideways, maybe down a little bit, maybe up a little bit, but probably mostly sideways for the remainder of the day. That's what I'm talking about. It's a reasonable buy, taking a chance. The problem the bulls have is the moving average has been impossible all day, bar one, couldn't get a hold above it. And then here, here, and then here. That's the problem the bulls have. But it's a credible buy right here, taking a chance that this is going to be the start of a swing up. So you buy above 62, stop below 62 or below 56. For the bears, they had a sell below 51, but I would have gotten out above 56 or scalp out 5 or 10 points. I think that's the ideal thing to do. In a trading range, it's usually better to take quick profits, 5 or 10 points. Here, if the bulls buy, I think it's okay to buy. And if we scoot up to the top of the range and the bulls can make 10 points, reasonable to take part off. Bears are hoping it's a double top, 60, we break below the neckline 62, and then below the low of the day, and then below the January 24th low. As I said, there may be bears selling below 56. That's the breakout mode. 50% chance we get a successful bear breakout and about a measure move down. That would be the January 24th low. 50% chance we'll end up with a successful bull breakout and about a measure move up. 50% chance the first breakout fails. So 50% chance this breakout is going to fail. By fail, I mean 50% chance we'll get a bull bar in the next bar or two or three, rather than continue down. Okay to be short. We have a really important magnet below. 50-50 bet that we're going to get a swing down or that we're going to reverse up from a failed breakout. It's probably a little bit higher that will go down because we have such an important magnet just a little bit lower. And plus, the trading range it's in a bear trend. You can see the hesitation. Instead of collapsing, there's just no energy. Once we started to get those dojis, 32, it was a sign that the market thinks the price is just about right. Bulls want 64 to close near its high for a failed breakout below the trading range and a possible swing up. I would get out of shorts above a bull bar closing near its midpoint. If it's only a one-tick bull body, two-tick bull body, you can always get out 2 or 3 points above the bar instead of one tick above. And if it closes back at or above the 56 high, you'll get bulls buying, taking a chance that we're going to get a swing up from here. I did buy above 62. I exited below 62. I did not go short because we're at the bottom of a tight range. And when you have these bear trends from the open that go sideways for several hours, you're usually not going to get much of a breakout. And therefore, I did not want to be selling at the bottom of a trading range, which is not high probability to start with. And then I know the profit potential, the risk reward is not very good. I sometimes will sell a breakout below a trading range or buy a breakout above, but not in this particular situation. Bear trend from the open and then trading range for 2 or 3 hours. Usually the market is not going to go very far. Reasonable buy for a swing up to the top of the range, maybe a little bit higher. On bears, I would get out of shorts 64. Just like it's not a great short below 47 because the profit potential is not great. It's not a great buy here. It's still probably a 50-50 bet that we're going to continue down and that 64 is just a pullback in a bear trend. So the math is really not very good for stop entry traders. The probability of everything is about 50-50. When you have 50-50, you need big risk reward, really good reward compared to risk. When the market is very quiet, you're not going to get that. So the math is really not very good for stop entry traders. It's more of a limit order market. Anything bearish, traders buy more 5 points lower. Anything bullish, they sell more 5 points higher. So they sell the moving average. They sell the close of 57, they close of 58. They sell 5 points above 56. And then they look to make 5 or 10 points on the reversal down. And the opposite is true here. You got bulls buying the 56 low, trying to buy 5 points lower, 10 points lower, buy the close of 63, trying to get a 5 or a 10 point scalp. And the bulls who bought that close, the bear close 63, it went up enough for them to make 5 points. Part of the reason 65 is a bear bar is you have bulls selling. You have stop order bulls buying, but you have limit order bulls from 63 close and from 56 low exiting. One of the difficulties with the stop entry bulls is 50-50 chance you're going to lose about as much as you hope to win. And if you get a couple loses in a row, like 62, maybe 64, it's really hard to make back the profit. So it's, in general, when you're in a very tight range, it's better to trade with limit orders and scalp. But most traders will get really upset and they'll panic. You know, if you buy the 46 close, you know, you panic out. If you sell the 56 high or the 57 close, what do you do when you see 58? You panic instead of selling more. And that's the problem that beginners have. They manage scale in trades badly and they end up losing a lot. So it's better to stick with the stop entry trades. Bulls do not want the market to get below 63 or below 65 because they know there's an important magnet a little bit lower. I've been talking about the January 24th low and the 4,200 big round number. And I said a lot of the bulls will not buy until we get to those prices. And once we do get to them, it looks like we will. Once we do get to them, we don't know that the bulls will buy. Bulls trying to get an IOI, a second reversal up from below the trading range. This will attract more buyers. If 66 closes near its high, I'll probably buy. The problem the bulls have is the one I keep talking about, the moving average. In bear trend days, the market tends to have a very difficult time getting above the moving average, and bears keep selling every time it gets to the average price, betting that average is too expensive. They think it should stay below average all day. Micro double bottom, 64, 66, neckline 65 high. So you could argue you could buy on a stop above 65, but it's a bear bar right below the moving average. The alternative is to buy above 66 or wait for a strong breakout above the moving average and then buy. Waiting for the strong breakout increases your probability. Given I keep talking about January 24th is really important support. Can we collapse if we trade below it? I don't think that'll happen. As I said, we have exhausted bears. They raced down to near a support price and then stalled. Usually, you're not going to get strong selling, but sometimes you'll get trend resumption down. This very tight range for 30 bars, that further reduces the chances of much of a sell-off. For the bears, the micro double top, 64, 66, but a bull bar, 66. Not a lot of bears are going to sell below 66. Bears, I'd get out above 66. It's the neckline of the micro double bottom. It's right below the moving average, and that's a problem for the bulls. So while it's theoretically a buy above 66 or 65, you're right at an important resistance zone. So if you're buying, it's better to buy closes. The bulls who bought the close of 65, for example, they were able to make 5 points. In fact, they were able to, well, yeah, if they bought the close, it's really interesting. If they bought the close of 65 and got filled at the close of 65, it went up 41 ticks, which is exactly what it had to do for them to exit with 40 ticks, 10 points. So no surprise that the high of 66 is exactly 41 ticks above the close of 65. It tells you a lot of bulls bought the close of 65 and placed a limit order 10 points, 40 ticks higher. It had to go 1 tick more to get filled, and that's what it did. And then the market sold off 66 when the bulls took their profits. And when bears sold, they don't want the market to get above the 65 neckline of the micro double bottom. More limit order bulls buying 66 low than stop order bears selling 1 tick below. It's a bull bar at the bottom of a weak bear channel. You know, we've been channeling down in a weak bear channel since 41 or so. it looks like we have to get below the January 24th low. It's such an important price, and we're right there. But if we get a decent bull bar 67 without going below 64, that would be another buy. Again, bulls buying are hoping for something the market has not done today, and that's a strong breakout above the moving average. So it's a low probability bet. So you take it hoping that the market surprises everybody with a big upside breakout, knowing it probably will not happen. Right, another new breakout to another new low of the day, but not a lot of sellers. 47 broke below the prior low, and 63 broke below the prior low, and 68 broke below the prior low, but not aggressive selling. Bears are hoping we collapse down to below 4,200, but they know we probably will not. This is an ETF that is an upside down spider, so it's basically the upside down E-mini. And you can see tight trading range in here, and not a good looking buy above that bear bar, not a great looking buy above that. We're at the top of a tight trading range. This is not this is delayed data on this ETF. On my other computer, I have real-time data for this. I sometimes look at it if ever I'm thinking about buying with a stop in a bear trend. I often will look at it just to remind myself that the market's in a fairly strong bear trend, a small pullback bear trend. Right down to the January 24th low. We rallied violently on January 24th from this price. And February 24th, we broke far below the price on the open and rallied violently again. Are the bulls going to buy strongly here? Well, probably not today, but they might tomorrow. We'll see. Bears wanted to accelerate down. When you get a pair of big bear bars like that, both big size bars closing near their lows, it's usually an acceleration down. We have it here. Here we have 3 bear bars. Here we had 2. We went sideways, but we kept getting lower highs. The bears would like to get another pair here, and then maybe a strong break below 4,200. But as I said, the market is not moving very much for the past 3 hours, and that reduces the chances we're going to go a lot lower. Difficult to trade. If you sold on a stop below 56, you'd probably get out above 64. If you sold on a stop below the January 24th low right here, you'll probably get out above 69 if it's a bull bar, or 2 or 3 points above a bear bar, 68, 69. And for the bulls, it looks like it's becoming a tight channel with a lot of bars. That will reduce the number of limit order bulls buying, especially in the final hour. They're afraid that we may accelerate down into the close. And bears, they're selling. They're selling for any reason. They're selling anything that looks bullish. 62 close, 64 close, above 62, above 64. They're selling at the moving average. They're less willing to sell below things. We're not getting strong breakouts with good follow through. So that means there are not a lot of bears selling at the low. They're selling bounces. So they're less aggressive, less confident that we're going a lot lower. Close below the January 24th low, 3 consecutive bear bars, tight bear channel since 59, all good. But I think, especially if you're starting out, this is not an ideal sell to close type of market. If you got 25, 26, that's reasonable sell to close. 29, 30, reasonable sell to close. 45, 46, reasonable sell to close as well. But we're not getting consecutive bear bars closing near their lows. I talked about that in here. When you don't get the consecutive bear bars closing near your lows, the market typically evolves into a trading range. Instead, we accelerated down and get a stronger bear trend with these two bear bars. Both good-sized bars closing near their lows and below the moving average. That combination usually means the market's going to go at least a little lower. We're in a buy zone. I've been talking about the January 24th low and 4,200 big round number. The bulls might be able to get a surprisingly strong rally by the end of the day. They might get up to the top of the trading range. So I would get out of shorts above any bull bar. I'd get out of shorts 3 or 4 points below a bear bar of 69 in case it starts to race up. And the bulls are at a really important price. And if 70 closes on or near its high, it's, I think, an okay buy, especially if it closes at or above the January 24th low. This is one of those situations you're buying in a tight channel, hoping that it's a small parabolic wedge, a spike or spike, and then on a smaller time frame chart, bounce, bounce, bounce. So if you take it, you can trade small, and then if it starts to go up strongly, you can buy closes and buy more as it goes up. But it's not, I think, a very good setup for taking a full-size position. Okay, closed below the 70 low, fairly prominent tail on top. So that is not going to attract a lot of buyers. Bears might get out. We're at the end of the day, so they might get out above a bull bar of 70 or 2 or 3 points above it. But bulls are not going to buy that very eagerly. The bears another low one, similar to 62, 64, 66. Not a very strong bear trend, and risk of profit taking and a bounce or rally into the close. Very often you'll get a trend reversal at 1230 or 1235. If it comes much later than that, it's less likely to go very far. So, but if we get a reversal around 1230, sometimes a little earlier like this, but it's more often around 1230, 1235. We could end up getting a decent bounce, possibly all the way to the top of the range. But the bulls need to see bars closing near their highs. They're not getting them. They need to see big bull bars closing near their highs. And we really have not had a single really strong bull bar today. 20, maybe bar 5. But all the other bull bars are not particularly big, and they had conspicuous tails. So not aggressive buying. The bulls, I keep saying, they have to get a close far above the moving average, and then consecutive closes above. They need the opposite of this, 2 big bear bars closing near their lows and below the moving average. The bulls need 2 big bull bars closing near their highs above the moving average, or at least 2 bars closing above, with one of them completely above the moving average. That is also good. Like this, 2 bull bars closing above the moving average and one of them big, you're usually going to get some follow through. Couple bull bars, big bull bars closing near their highs, one of them completely above the moving average. That's probably going to get some follow through. Same right here. Not much overlap between the bars closing at or near their highs. You're probably going to get some follow through buying higher prices. The bears have been waiting at the moving average with limit orders all day. Will they buy back shorts here? And will we get a short covering rally into the close? I would say 50-50 chance. Near the moving average, near the double bottom. Will the bulls who bought scalp out 5 points? And will the bears continue to sell with limit orders around the moving average? Will we get another new low? I think this is looking, it's the bull's best chance. I think so far, at least in the past several hours, we went below a very important price and arguably a parabolic wedge, but they have to break above all those bear sell limit orders at the moving average and at the bottom, at the double bottom. We don't know if the bears are swing trading. The bears are running out of time, so I think the odds of a big sell-off are getting less. And I said earlier, when the market's doing this, usually you're not going to get a big move in either direction. And since we're down and we're not going to get a big move down, we're probably not going much lower. So the bears are probably scalping, sell with limit orders and then get 5 points, buy back shorts. And bulls are trying to break above the moving average. This is the end of the hour, bar 72, a multiple of 12. The bulls would like the 60-minute bar to be a big bull bar closing on its high, but with 1 minute left, that's not going to happen. At a minimum, they'd like it to close about the middle of the hour. The hour opened with bar 61, and that's the low of the hour. So that's the midpoint, and that's why we're stuck right there. The more it closes, I messed that up. But the more it closes above the midpoint, the more likely the bulls are taking control, and it will go higher. If it closes pretty much right at the midpoint, it increases the chances we're just going to go sideways. So that pink line is the midpoint of the hour. Okay, we closed below the midpoint. So 60-minute bar, a bear bar, closing below the midpoint and closing below the bottom of the trading range. For the bears, it's a low 1 at the moving average, a double top 66 with 3 bull bars. I'm not going to sell it. So right now I'm flat, waiting to do something, buy or sell. 3 bull bars, probably buyers below 72, but late in the day, it's usually a losing strategy to buy with limit orders late in the day in a bear trend. Low 1, but 3 bull bars at support, so I'm not selling. And it's too late in the day for me to buy with limit orders in a bear trend. So I'm on the sidelines right now waiting for a better sell or waiting for a better buy. Bear bar closed below 72, but conspicuous tail. For the bears, it's another reversal down from the moving average. It's okay to sell it, but I think really difficult to manage. Easier to make money with limit orders, selling at the moving average, selling bull closes. Harder to make money selling at the lows. And bulls have been buying new lows, and they've been making money most of the day, pretty much all day long. And that makes it difficult for bears to sell with stops. If the bulls are buying at the low, bears don't want to be selling at the low if the bulls are buying at the low and making money. So this is, not a lot of great opportunities to sell, 44, 51, and you get 5 or 10 points and then you wait for the next trade. But these shorts are really difficult, 64, 66, 72, bull bars, bear trend, not very strong for several hours. Bulls running out of time. If you're looking to buy a reversal at the end of the day, it usually has to happen by 12:30, 12:35. Usually it happens around 12:30, 12:35. And the later you go, the less likely you'll get a reversal that goes very far. And for the bears, it's still sell the close, sell for any reason. But you're selling at the low of a bear trend, And the bear trend over the past 3 hours has not been particularly strong. So it's really not a very good sell. You're selling hoping we collapse below 4,200, but look at the past 3 hours, past 30 bars or so. That is not a strong bear trend. Even if I do that, it's still not a very good looking bear trend. You look at it and say, oh, it looks kind of like a trading range, a bear leg in a trading range, so we should get a bull leg. So do you really want to be selling at the low? Not, the probability is not very good, and the potential reward is not very big. What happens if you sold below 74? You can see it's hard, right? You have to get out. At some point, you don't want to get out above 72. You might get out 2 or 3 points above 74. You might get out 1 tick above the bull bar 75. And for the bulls, it's a double bottom 70, 75. But it has the same problem that every reversal has had all day. Near the moving average, and the bulls have been unable to get above it. They've gotten above it a lot, but they can't get far above it. And every time it goes above it, we then get a new low. Outside up, but a stop order buy is above the high of the bull bar 75, and that's right at the moving average, which has been resistance all day. So not a good buy. So the bulls have a double bottom 70, 75. The bears have a double top 72, 74. And the bears have the problem that selling at the low of a bear trend that has not been very strong for several hours. So it's more limit order trading. Traders buying bearish things, scalping out, selling bullish things, scalping out, selling 75 close, selling with a limit order at or just below the moving average, and then trying to get 5 or 10 points, and then look for the next trade. Limit order bull computers, they'll buy below 75. Individual traders, I think it's difficult. Things move quickly, especially at the end of the day. And look what we've been doing in here, a lot of reversals. One of my general rules is if we have not begun any trend by 75, I'm usually not going to take any more trades. And we've been in a tight trading range for more than 4 bars, 4 or more bars. And if 75 is not a good buy or sell signal bar, I usually do not take any more trades. If you start to take trades after bar 75 and the market is in a tight trading range of bar 75, the probability is if you do it on 10 different days, you will lose money. So some days you might get a big win. Maybe 2 or 3 of the times you'll get a big win, but 7 or 8 of the times you'll get losses, and the losses will add up to be greater than the wins. So maybe a 30% chance that if the market's in a tight trading range at bar 75, you'll get a trend at the end of the day. That means 70% chance, no. And when I say that, I'm talking about in either direction. Obviously, we're in a bear trend, right? But sideways bar 75, sideways for 6 bars here, 7 bars, it lowers the probability that we're going to go down very much. The bears are trying to break below the 4,200 big round number. If you're a bear and you sold below 75 or 76, what are you doing right now? You're thinking, uh-oh, I'm down 6 points. How many points was I going to make? I was hoping to make 5, and I'm already down 6. But you can see the problem. For the bulls, it's a failed breakout below a double bottom, but this is getting late in the day to be taking stop entries when the market's in a tight trading range. So it's better to wait for tomorrow. Just like the bears who sold below 76 are in trouble. If you buy above 77, right below the moving average, you're betting the day is going to do something it has not done for 77 bars, break strongly above the moving average. Bears fighting to keep the trend alive. So they're selling bounces, hoping that we get a sell to close trend into the end of the day. But we have a lot of bars that are mostly overlapping. And when you have that, the market rarely goes very far. Consecutive decent-sized bear bars, closing near their lows, closing below the 4,200 big round number, but I'm going to wait for tomorrow. The day started out with a series of sell climaxes with bad follow-through, and that kind of a day typically evolves into a trading range. Sometimes you get a reversal, and instead, 25, 26, we broke out, and then we started to get bars without much overlap, so the bear trend became stronger. A lot of times when the market tries to bottom and then breaks below the bottom, it'll fall for about a measured move down. So this is the high, and this was the attempt at the bottom, and we did not quite reach a measured move. We were sideways for 6 days coming into today, and chances are we're going to be mostly sideways today, although I said I thought we would get down to the January 24th low and the 4,200 big round number, because those who wanted to buy did not want to buy. This is the daily chart. They did not want to buy here and put a stop there. It's risking too much. So you had a strong reversal up and then nobody willing to buy that high. So there are bulls willing to buy, but lower. And the reversal down today is so strong, many of the bulls who want to buy want to see the selling stop. So they'll want to see a decent bull bar in the next day or two. I've been saying that 50-50 chance, maybe slightly better than 50-50, we would form a higher low. Sometimes when you get a bottom and then a very big bear bar, it's just a sell vacuum test of the earlier low. But the bulls will need a pretty good bull day tomorrow if that's going to be the case. Right now, it's looking like we're going to go lower. If we break below the 24 low, it's probably going to be a minor breakout, lasting a bar or two, and then we'll try to get a wedge bottom. The bears are hoping that we'll go down for a measured move. We have a head and shoulders top, left shoulder, head, right shoulder, and we broke below the neckline here, and it's about 400 point stall, so the bears want to get down to around the, well, you can't see it here, but they're trying to get down here to actually here, pre-pandemic high, right before the pandemic in February 2 years ago. We sold off, and a lot of traders want to see a test of that breakout point. Still about a 30% chance that we'll get down there. So 70% chance we will reverse up before we get there. Anyway, on the open, we had a big bear bar 1. It was consecutive bear bars, 4 consecutive bear bars. And I said, some traders will sell the close, but a lot of traders will wait for follow through. And then 2, we had a bear bar. And I said, it's sell the close for a swing. We have consecutive bars, 1, 2, with one of them being big and closing near its low. And that's a sell the close bear trend. We had another pair of bear bars, 3, 4, but then a bull bar 5. But nobody wanted to buy above 5. It's a higher low double bottom with yesterday's low, and it's a bull bar closing near its high. But it's 4 consecutive bear bars today, and then 7. Plus it's a 7-bar bear micro channel. So most bulls will want a second reversal up, so not a good buy. Big outside down, 7. And then the bulls got a second reversal on 7, a possible low of the day, and I think it's an okay buy. But after the bear surprise 6, a lot of bulls will want to see a bull bar closing near its high. I think I bought above 7. I don't remember. If I did, I'm pretty sure that I did. And I was disappointed at 8, and then I get out, I think, with 3 ticks profit on the next bar. And we sold off on the next bar. Now we might be forming a parabolic wedge. We have 4 big bear bars with bad follow through over here, so we're probably not going to get all that good follow through here. And we did not. A parabolic wedge 4, 6, 9, but I'm not buying above a little doji bar. And the bears got upside down. Now a pair more bear bars. So it's still solid close, sell for any reason. Stop. I get out a tick above a bull bar that closes above its midpoint. I'd get out 5 points above any bar. 11, possible parabolic wedge. 7, 9, and 11, 7, 9, and 13. Reasonable to get out of longs. It's a possible low, but if it does not go up pretty quickly, I would get out. Not looking good. So for the bears, it's a low 1, but it's a doji bar after a bull bar and a parabolic wedge. I'm not willing to sell below 14, but sell the closed bears. If you're trading always in, you have to get short again, and you have a low 114, but not a good sell thing anymore. The alternative is to sell with a stop 1 tick below the most recent low, the 13 low. But to me, we're getting a doji here, 2 dojis here, smaller bars sideways. I think this is not going to go a lot lower. Pair of bear bars, bear bar closing on its low, but bull bar 18. The market often tries to reverse 18, and these few bars here could be a final flag. But again, big tail on top, so that will reduce the number of buyers above. I think it's an okay buy, taking a chance that we get up to the 14 high in the moving average, but I think it's probably going to be a minor reversal because the bear channel is tight. Reasonable for bears to exit because it's possible we could go up pretty quickly, so okay to get out above 18, and okay to get long above 18 or 19 and see what we get. Pretty good bull bar. It's a bull surprise bar. It's not especially big compared to the bear bars, right? Plus a fairly conspicuous tail and a close below the 14 high. The bears will try to get a double top at the moving average. Reasonable to be out of shorts, reasonable to be long, but if you're buying in a tight channel and you're getting a minor reversal, it's usually good to scalp at least par, and then if the market does not go up, if it does not go up pretty quickly, just scalp out of the rest. I think I bought above 19, and I don't remember if I got out with 5 points or 10 points. I don't remember. Big problem for the bulls, 21. For the bears, a double top bear flag, 14 at the moving average. We might be forming a tight trading range in here, so we may go sideways, but there's a 40% chance that this is going to go down for at least a measured move. So if you're long, I'd get out of longs, and if you want to take a chance on the short, you sell with a stop 1 tick below 21. And now you got a micro double top with another bear bar closing on its low. So it's a wedge, 18, 20, 22, a double top, 14, and we have 2 good bear bars. So it's a reasonable short below 23. Bears are hoping we break below the neckline and fall for a measured move down. Bulls are hoping we get a higher low. Okay, a pair of decent bear bars, good sized bodies closing on their lows. The character of the day might be changing. We were stalling in here, a lot of sideways bars with prominent tails, and now we're getting that. A pair of big bear bars closing on their lows with at least one of the bars completely below the moving average and very little overlap between the 2 bars. It's a good enough bear surprise. We should get a second leg down. And it's possible it could be a measuring gap. Now we have a lower low, major trend reversal 27, reasonable to buy. But I said it's a small bull bar after 2 big bear bars, and we should get a second leg down. So If you buy above 27, it's a scalp. You get out with about 10 points or around the moving average. The bears know it's not a very good buy, but they're not going to sell the 27 high because it's a possible low of the day. However, they will place limit orders to sell 5 points above, 10 points above, or at the moving average, or a couple points below the moving average. And that was 28. 29, a bear inside bar closing near its low. We're still in a small pullback bear trend. And if you get out of shorts above 27, you sell again below 29, taking a chance that the small pullback bear trend lasts all day. Another pair of decent bear bars closing on their lows might go lower. The bulls are hoping for a wedge, 18.27. Now, we got 3 consecutive bear bars closing near their lows. We're probably going to get at least a small second leg down. You don't have to get out above 32 of bear doji. You can, or you can get out 2 or 3 points above it, or 5 points above it. If you did get out, you have to sell again. If you're trading always in, if you're trying to stay always in the market, you can sell on a stop at the prior low, 31, or you wait for a bear bar closing near its low. 34 has a pretty conspicuous tail, and it's after that II, consecutive inside bars. We had a failed breakout above. It could be a final flag, and an II late in a trend is often the final flag. So I'm less willing to sell below 34. Okay, now we got a bull bar closing near its high, possible parabolic wedge, 27.31. And I would get out of longs, I would get out of shorts above 36 and possibly get long, but it's a really tight bull channel. So if we do go up, it'll probably be a minor reversal. Maybe we'll get to the moving average in the 34 high. Now, 37, another II breakout mode, but it's the second attempt at a bottom, so there's higher probability for the bulls. You could sell below 37. I'm not going to. I would buy above 37, even though it's a bear bar. It's a second consecutive II. The second attempt to reverse up, that's a higher probability. So I would get out of shorts above the II, above 37, or above the 36 full bar. You could sell below 37 or below 35. I'm not going to. I think the bulls are going to try to get a couple legs up. Maybe they'll break above the moving average. Not looking good for the bulls. If you bought above 37, bear bar 38, you could get out, or you can keep a stop below 35 and see what you get. Good bar for the bulls, but similar to 20, not particularly big, and a fairly conspicuous tail, so it's probably a minor reversal. Disappointing 37, 38, 39, and now even though a bull bar 40, it's fairly disappointing. So reasonable to try to get out with 5 or 10 points, maybe a double top 34 at the moving average. And that's what we got. Double top 34 at the moving average, a low 2, and a bear bar. So if you're still long, if you did not exit at 10 points, which I think you should, it's a sell below 41, double top bear flag 34, a low 2, 37. A terrible entry bar for the bears, 42. If you took it, do you get out above 42? No, if you took the sell, your stop is above 41. However, disappointing 42. A lot of the bears who sold on a stop below 41, disappointed 42. They tried to get out around break even. A lot of times if you're disappointed, you place your limit order at break even or a tick or 2 or 3 worse than break even. So you're willing to lose a few ticks just to avoid a big loss. Okay, big bull bar 43, but closed below the moving average. Bears are selling at the moving average. Bulls are taking profits at the moving average. The bears, a double top 41, is still on the 41 sell, but it's a bull bar, so that's not going to get a lot of sellers below 43. $44, that's interesting. A bear bar closing near its low. Micro double top 41. You could call it a truncated wedge, 3 legs up, 36, 40, 43, where the third did not go above the second. So I call that a wedge that is truncated. The third leg did not go above the second. But you could simply call it a double top or a low 3 or low 2 at the moving average. In any case, if anybody's long, you have to get out, and bears, it's a reasonable short. We might be forming a tight trading range after II here and II here. The bears see this as a double top. They want to break below the neckline and a measure move down. In general, a double top and a bear trend at the moving average with a decent sell signal bar, 40% chance you're going to break below the neckline and fall for about a measure move down. So it's an okay swing. Another pair of decent bear bars, 45, 46, so more sell to close. Bulls want double bottom, 35, and reasonable to get out above a bull bar closing above its midpoint, or 4 or 5 points above a bear bar, 46. It broke below the double bottom, 46, 35, and then formed a bull bar. It's a possible lower low double bottom, low of the day, but not a very good buy signal bar, plus 3 bear bars, 2 of them very good bear bars. Reasonable to get out of shorts above 47, and it's reasonable to take a chance and buy. Maybe we'll get a swing up. Maybe we'll break above the neckline of the double bottom and go up for a measured move. But the bulls need to break above the moving average. And when I say break above the moving average, they need a big bull bar closing on or near as high, far above the moving average. If they get that, then we'll get a swing up. But if they don't get that, then every rally will be minor, and bears will keep selling at the moving average. 49, another low one, a bear doji. I think you can get short below it. I think it's okay to exit longs below it. We might get a double bottom pullback, double bottom 36, 47. So we may get a pullback to a higher low. The stop below 47 is not far below 49, so you could rely on the stop and give it time. I personally, if I bought above 47, I would get out below 49, a bear bar closing near its low, turning down from the moving average. But we did not go below. Now we finally have a breakout, 50, a close above the moving average, a close above 49, possible measuring gap, a tail. And what did I say about the close above the moving average? I said I wanted to see a close far above the moving average, and I wanted to see a close above the lower high, 41. So if 51 is not a strong bull bar, I think bulls will get out and bears will sell. And then we got 51, a bear bar, another lower high, double top 44, 2 legs up, 48, 50. Bulls get out, bears will sell again. We may be going sideways after these 2 IIs. And when you have a sell to close, a bear trend from the open, and then it starts to form a trading range, most of the time the range will last all day. 20% of the time you keep going down, 20% of the time you get a reversal. 5 consecutive bear bars outside down, 55, but possibly a double bottom pullback, double bottom 35, 47. So if you're selling, and it's okay to sell below 51, below 52, below 55, there may be buyers down here. So I would rather think of this as a trading range and sell high and buy low and scalp out 10 points. And if there's a breakout in either direction, then look for a swing trade. Breakout below the outside down bar, but a perfect double bottom, 47, 56 at the bottom of a trading range, 32 or 36. High 2, 54, possible low of the day, but close not on the high of the bar and close not above the moving average, and did not form an 00 consecutive outside bar. Not an ideal buy. You're right at a price, the moving average, where bulls have been exiting and bears have been shorting all day. 3 consecutive bull bars. It might be becoming always in long. 2 consecutive closes above the moving average, but the bars are not big. and we still are getting lower highs. So if I'm going to be buying at the top of a trading range, I want to see a breakout above the range, 51, 41. Otherwise, there might be more bears selling the close than bulls buying the close. And there were 59, big bear bar. Bulls are hoping that we get a higher low. But if this is going to be a double bottom pullback, normally the bear bar is it. Traders buy the close and it goes straight up. So if it lingers down here, 2 or 3 sideways bars, it reduces the chances that we're going up, and it increases the chances that we'll stay sideways or go down. And that's what we got. 61, 3 bear bars. It's still a possible double bottom pullback, but it looks like we're going to get down to the January low and maybe the 4,200 target that I've been talking about for several weeks. Bulls trying to get a double bottom pullback, 62, a reasonable swing buy. You can buy it, hope that we break above the moving average, but it's right below the moving average, and you can only do that for a swing. You're buying in the middle of a 30-bar trading range, right below the moving average, where there have been sellers all day. So okay to get out of shorts if you shorted below 59 or 60, and okay to buy. Higher probability, wait to see if we get a close far above the moving average and above the most recent lower high, 58. Outside down, 63. The bulls get stopped out, and the bears are hoping that this is sort of a swing down. Probably not most of the time. Once you have a sell the close bear trend that goes sideways for 20 or more bars, it's not going to go very far up or down for the remainder of the day. This day we did. You can see this black price here, that's the close, so we fell for more than a measured move down. But I think a tough short below 63. 64, a failed breakout below the tight trending range, a high 262. Reasonable buy, but a tight channel and just below the moving average. So not a great buy. I would rather buy further below the moving average, or I'd rather buy a breakout above the moving average. It's tough for the bears. If we sold on a stop below 56, I would get out above 64 in case it races up. Instead, we have another outside down bar, 65. I think really tough for stop order bears, selling below 62, bull bar selling below 64, bull bar selling at the low 63. Easier to sell with limit orders near the moving average than with stop orders below. This is possibly a tight bear channel that could go down a long way. IOI 66, so it's a low one, but a bull bar, and a 4-bar tight trading range, not a very good sell. And for the bulls, it's a micro double bottom, but you're right below the moving average. Big tail 66, bear bar 67. I would not buy. So you're either short or flat. 3 consecutive bear bars, 69, breaking below the January 24th low, but the bars are not all that big. The bodies are increasing, but it's just not all that big. So there may be buyers at that 24 low, just like there were on January 24th and on February 24th. It's sell the close, sell the low, but it's just not that strong a bear trend right here. 70, some kind of a wedge, different ways to look at it. Many push it down, spike, 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 and then a micro wedge here, maybe a wedge 1, 2, 3 there, but not a big bull bar closing near its high. It's a possible low of the day. We might get short covering into the close. I'm not opposed to buying it. I think it's better to wait to see if we get a big bull bar closing there its high, especially if we get a breakout above the moving average. Bears, reasonable to get out of shorts above 70. Weak entry bar, 72, close above 71, but big tail at the moving average and at the 56 bottom of the trading range. So it looks like bulls are scalping and bears are selling at resistance with limit orders. For the bears, it's a low one, but 3 bull bars. I'm not going to sell with the stop. It's a limit order sell. 73, bear bar, but closing at the January 24th low and not far below. So not a very good sell to close bar. 74, bear bar closing near its low. It's a better sell to close bar. Stop above 72 or exit maybe 5 points above a bear bar, but it's really not ideal. However, there probably are more sellers than buyers above 74, so I would not buy the double bottom. Bull bar, 75. We've had lots of bull bars today. The bears have sold the close of every one of them, and they've sold above bear bar 74. They've been selling with limit orders at and just below the moving average, so there probably are more traders selling 75 than buying. So I would not buy or buy above 75. Another bear bar 76. We're getting late in the day, breaking below the double bottom 70. We're right above the 4,200 big round number, but you're running out of time, so you have to make quick decisions. It's sell to close, but all the way down, a lot of reversals. Really not very good. And 80, we finished the day right near the low. Stop entry traders today. You could sell below 1. Below 2 is not great. Below 3 is okay. I would not buy above 5 because of 4 bear bars. Outside down 6. You could sell below 6, but I think not ideal. We're right near last week's low, yesterday's low. Buy above 7, high 2, sell climax, that's okay. Bears, they'll sell below 7, a new low. I would not sell below 8, a bull bar. Not a great sell below 10, not a great buy above 10. I would not buy above 10. I would sell below 9 or 11 or 12. Not great stop order selling through here. Not great stop order buying. I think you could buy above 19, but it's probably a minor reversal. I would sell below 23, a micro double top at the moving average after a tight bear channel. Sell below 24, below 26, buy above 27, sell below 29, sell below 30. Not a very good buy here. Not a very good stop entry sell there. I here, I'd buy above 37 or 36. You could sell below 41. I certainly would get out of longs there. I would sell below 44. I'd get out of shorts above 46. Possible buy. You could buy above 46. I would not buy above 50. I want to see a breakout far above the moving average. Sell below 51, 52, 54, bottom of the trading range. Not a great sell. Probably better to sell with a stop. Below 47, even then, the bars are small, not much energy. Buy above 56, double bottom. I'm losing my voice at the end of the day. That's one of the reasons why I'll be cutting back the chat room to 8 days a month starting in April. It's just too difficult at the end of the day. It's hard to talk, and it takes away some of the fun. So bulls, buy above 56. Bears, it's a low 160. I would not take it. Sell below 61. I would not do it. Bulls, double bottom, pullback 62. Reasonable swing buy. Higher probability. Wait to see if we break above the moving average and then buy. Outside down 63. New low of the day. Some bears sold on a stop below 56. Not great. 64, a high 2, failed breakout, but a tight channel. I'm not going to take the buy. Outside down 65. If you exited shorts above 64, theoretically you sell a new low below 63 or below a bear bar 65, but I think really not good stop entry selling. 70, a possible start of a short covering rally. Reasonable buy above 70. You could sell below 74, below 75, below 76, below 77, 79, getting pretty late in the day. Limit order traders, bear channel, small pullback bear trend all day, but a lot of limit order trading early on. bulls were buying at prior lows and or 5 points, 10 points lower and making money. And bears were selling above bear bars like 12, like 10, and with limit orders near the moving average, at the moving average, or a point or two below. And they've been selling every bull bar all day long, 20, 22, 28. Every bull close they sell, 40, 43, 50. And a bear trend, every time there's a bull bar, especially a bull bar near the moving average, it's a short. You might put a stop 5 or 10 points above. You may add 5 or 10 points above, but limit order bears sold all day long. This is a sell climax day, and 75% of the time, the day after a sell climax day, we'll have at least a couple hours of sideways to up trading that starts by the end of the second hour. 50% of the time, you can follow through selling right on the open. But even if you do, 75% of the time, you'll have at least a couple hours of sideways to up trading starting by bar 24. Markets deciding, is the bear trend resuming on the daily chart, which it is, but will it continue below this and fall a lot lower, or are we going to reverse up tomorrow? The bears need a reversal up tomorrow. If they don't get it, chances are we're going to get down to the February 24th low and maybe below it. Question, did you buy above 36? The I probably did. 47. I think I bought above 47. And 56. 56, double bottom. I may have bought above it, but on a tail right below the moving average. I don't know that I bought above it. I was selling below bear bars, especially micro double tops like 23. But scalping out, and where else? 44, 51. I did take a couple more stop order buys. I don't remember if I bought. I think I bought above 62, and I'm not sure if I bought above 71. But if I did, I'm sure I took quick profits, so I scalped out. I was disappointed. I'm sorry, 70, not 71. You know, I want to see an immediate big bull bar if I'm buying in a bear trend. If I do not, I'm going to be pretty quick to get out. Question, there's very little open interest all day long, and the spider options on the call side. Plenty of open interest on the put side all day. That seemed unusual. Typically, call and put interest is about balanced. Is that significant if looking to swing trade during the day? I don't look at option open interest. In the old days, I used to look at put-call ratios. I used to look at everything. But I realized I was not making any more money, and it was stressful, unpleasant. So I decided that all I'm going to do for my day trades is look at the chart in front of me, knowing I'm missing 100, 1,000 other things. I don't care. There's enough to trade right here that I don't want to be worrying about all the things that I'm missing. I'm just happy to take the trades that are on this chart and not worrying that I'm missing out on a whole bunch of other trades on other time frames and on other charts. Question, do you think it's reasonable to buy for a 5-point scalp or to buy 5 points below bar 55, below 55, taking a chance we either form a double bottom or a slightly lower low? Okay. Is it reasonable to buy 5 points below 55 and exit with a 5-point profit? If you're doing that, that's what you're doing, right? So he's saying limit order bulls are making money all day. Can you buy with a limit order at the 55 low and risking 5 points, hoping to make 5 points? The stop is the one thing that I'm concerned about. You could buy the 55 low and put a stop 1 tick below 46 and hope the lower low major trend reversal holds. and you would have been lucky. You would not have been stopped out. But what the bull computers are doing all day long is at every prior low, they buy and buy more 5 or 10 points lower. And then when it gets back to that low, they take their profit. And bulls will do that here as well. So if I buy the 55 low, I'm not eager to exit 5 points below because that's below 47, and I know bull computers will buy the 47 low and buy 5 points lower. So why would I want to be exiting along when I know bull computers are buying? So I personally would not exit 5 points below. If I bought the 55 low, I would not exit below 47 or 5 points below 47. I probably would risk 10 or 15 points and look to buy maybe 5 points below 47, betting it would get back above 47, which it did. So I would not buy the 55 low, scalping for 5 points, risking 5 points. I would not do that because you'd be getting stopped out below 47, which is a place where bulls will buy, as you can see over there. All right. Hope everybody has a good night.